remember the deals that are lost more so than the deals that you won. Right. And maybe because you lose more deals than you win if you talk about from lead to closing, yeah, nobody has a plus 50% conversion rate from lead to close. I mean, maybe some do, and that would be amazing. But like inherently, you're going to lose more than you win. But if you only focus on the losses, you get into a negative headspace. And like we've talked about, positive attitude is so much of all of it, right?
Well,
Positive attitude, positive action equals transaction.
even if you are the most cynical person in the world, you have to acknowledge that if you keep a positive attitude, you can work longer, right? So even if you are a person that thinks like, oh, this whole, mindset thing is just BS, which I don't believe that at all. You can see it that when people do maintain a positive attitude, they work better, they work longer. So if your attitude's not right, like get it right, fix that first, and then start working. Hey guys, thanks everybody for joining today. We have a great episode with Max Leaman and myself. Hey Max.
Hey Eric, thanks for having me.
So today is going to be another episode where we're discussing the broader Austin metro market. Today we're going to discuss first the mortgage market and what we anticipate will happen in the near term, and maybe even be so brave as to talk about what will happen in the long term. We're going to talk about the 5-county metro and what happened in the month of October, do a bit of a forward look as well. We're going to slice it up into resale and new construction. I think that's interesting to look at and to talk about the implications of the different behavior in each market, implications for our clients, also implications for real estate professionals like LOs and real estate agents. We're going to wrap it up with national leading indicators. What do we think will happen in the next quarter, 2 quarters, based on what those indicators look like? Spoiler alert, they don't look awesome, but we'll run through everything. And finally, we'll talk about strategy. And, I think that's probably the most impactful thing we can discuss. It's also the topic that doesn't change a whole lot. And I love talking with Max about it because you've worked through a recession in the past. You came out of it so much stronger than whenever you entered that recession. And I think that it's kind of like just a good reminder that those that continue to work hard through do come out ahead. So Max, thanks for joining us, man. How are you? How are things? What's the vibe? We'll do the vibe check to get started.
Yeah, vibes are good, man. Mortgage perspective, we'll do a little bit more volume this year, both as Lehman Team and as loan people. Margins have decompressed very, very slightly, but that's certainly been helpful as well. And, overall, I think this year for us is successful, all things considered. People often ask me, how are you doing? And I say, it's been much worse. We're doing great.
Making money again. So that's a good thing. I know we talked about that.
It's much better to not watch your bank accounts just go down. But, it's overall, we've had again, a successful year. And, as we'll get into, I think next year will be slightly better. I don't think we're going to blow it out of the water by any stretch, but, I think we're getting back to maybe pre-COVID normal-ish type things down the road.
So real quick to back up for a sec, you mentioned really quickly, and it's something that you and I talk about a lot because it's sort of like how we sort of contextualize how your company's doing. You said, oh, so we're doing better as both Lehman Team and loan people. Can you explain the difference and why that's?
Yeah. So, for those that don't know, I've been in this business for 25 years now. I couldn't even grow a beard when I got in here, and now I look like Santa Claus. But Lehman Team's always been my baseline. We really got going with Lehman Team in about 2009, 2010. And that was really been that baseline where we really started to grow that out, multiple loan officers on the team, all those things. And we built that to a $300 million pre-COVID team. We started Loan People. We opened our doors in January 2020. We started adding other branches in 2021. And so, as we've added branches and other loan officers, Lehman Team's market share of the overall Loan People volume has actually gone down, which is a good thing. But you have loan officers come and go. You have branches that come and go, both in Austin and other cities in Texas and other states outside of Texas. So as you look at very specifically the Austin market, Max Leaman, the loan officer, if I still reported my numbers, I'd still be the number one loan officer in Austin. And so I've always felt like that's a really good threshold. Where is Lehman Team in comparison to the Austin market, both in transactions, volume compared to other loan officers? You and I have often been able to find a correlation between your leads group and Lehman Team which is kind of a similar situation. And so it's just always been, for me, a good constant of where is our market share locally. But then to be able to say that the company is doing more volume, it means we're growing properly outside of Austin, El Paso, San Antonio. We're in Houston. I've got a really good group in Jacksonville, Florida as well. And next year is all about growth and looking to expand into other markets as well. But grounding it, Lehman Team is that kind of baseline.
Yeah. So you basically have two business models here. I mean, you've got, or two revenue streams, right? You have your team that you ran successfully and continue to run successfully for a long, long time. Is that doing okay? That, in my opinion, that's why we talk about our leads program. That's a
Right.
pretty good, like, canary in the coal mine for the city of Austin, or the metro of Austin. And then obviously, whenever you are growing a company at large, that company growth, if you're continuing to take on lots and lots of LOs and offices and whatnot, that's not a strong indicator for the overall market. Like, how's it performing? And that's why I like to call you and ask, how's Lehman Team doing? Because I can then compare it with, our leads program. How's our leads program performing? And then we can bro out and talk about, the growth of the brokerage and the growth of loan people, and see how
Right.
are we able to outperform the market and grow, in this down market. And not to get too long-winded, but like, I strongly believe that, recessions and down markets are where companies are made. That's where you actually have a lot of opportunity to grow. It's just really hard. It's really hard for a number of reasons. So.
Yeah. I had no idea how hard this was going to be when I got into it. As far as owning a mortgage company, the idea was, I just want to build the company that, as a top producing loan officer, I want to work at.
Right.
Where do I have the products? Where can I get lean pricing? Where do I have like all the things that I needed? You go back to 2020 when we opened our doors and we didn't know what was going to happen. And then, COVID knocked the wheels off, but it at least proved, more than anything else, it proved that my concept actually does work. My tech stack works. My loan officers were able to do more volume in the same amount of time, or the same volume in less amount of time. So that, like, it was a really good kind of trial run in the beginning, unbeknownst to me, that it works. Then you get into the recession times, and we've talked about it, right? And that's really where you separate the men from the boys, if you will, the good from the rest, the great from the rest. I mean, for 20 years, we all thought we were really, really good at our jobs. And it turns out, like, we probably were, most of us, but also we had huge tailwinds. If I'm going downhill, if you're a bike rider, right? If you're going downhill, and you're pedaling, you're going faster than if you're not. But
sometimes you don't even have to pedal, right? When the hill's
exactly. And if you're pedaling just as hard, but you're going uphill, you're not going very fast. And that's when you figure out how strong you really are, and how fast you can get up that hill.
That's a great analogy. I mean, sometimes the hill gets too steep, you're too out of shape, you just simply can't do it. Yeah, no, it's tough. Going uphill sucks, man. Going uphill with wind in your face is even harder. And I feel like, we're on year 3 of a pretty steep hill. It continues to get just a little bit steeper every year. So hopefully next year it gets a little less steep, right?
I think next year for everybody will be better. We'll get into why I think that, but again, no one's going to crush it. No one's retiring off what they do next year, but everybody's gotten smarter, more nimble. I mean, I think you've seen it from the brokerage perspective, but where we really, like, being lean is really, really important to my business model. And we've done a really, really good job of monitoring expenses, cutting fat, getting rid of not staff, but things that we don't need, finding contracts that we didn't realize we still had, licenses that we didn't need, renegotiating with all of our vendors. And we've done a really, really good job of that very much this year, but even last year, some as well. So, reducing cost and finding all that leakage. When everybody's making $1 gajillion, nobody's really thinking about where they need to save money.
I can argue that it's the wrong thing to look at, because unless something is glaring, you have so much money fall. Like in 2021, there's so much money falling from the sky. Why are you worried about this few $100 a month SaaS expense? It just doesn't matter.
Exactly.
And then things tighten up and you say, oh, wow, now I have time to do this and it does matter. So let's go figure it out. And to jump forward to, the hopeful pot of gold at the end of the rainbow, like, when everything's finally turned, we will maintain these efficiencies. We won't be bloated, and the profitability will be really nice. So I'm looking forward to this.
And I think too, it puts you into a good mindset. Like, for example, one thing that we now do as a company, anytime we sign a new agreement with whoever the vendor is, I immediately, as soon as we sign it and we get going, I immediately give them my notice to terminate.
Wow.
Because they all have that. If you don't give them within 30 days, then it rolls over and you're on another year. So I immediately give it to them as soon as we get going, this is now my notice, this terminate. Doesn't mean that I'm going to, and I'm happy to renegotiate it at the end of the term. But if we forget or whatever, like I've given you the notice. And I found that actually to be pretty helpful, especially on negotiating the next contract, because I've already started.
Yeah, no, I think that's super, super smart. I'm going to steal that. I love that idea. Thank you.
I stole it. You're welcome.
So moving on to, mortgage market. What have we seen? Like I include a 90-day look with every newsletter we send. It looks like things have declined a little bit. It looks like they've got a little better than they are now. It doesn't look like, rates are in some sort of free fall by any means. I mean, what's going on? Like where are they right now? Where do you think they're going to be at the end of the year? What's going on with rates?
So we're in kind of this slow burn, and I've talked about it before, actually. Like if you look at previous year, the 2001, 2002, 2003, when I got in the business, there was a lot of it wasn't this sharp drop. It was a slow burn. So you'd have people refinance 2-3 times over the period of call it a 3 to 5 year period. And I think that's really what we're seeing. If you look, let me just pull this up here. I've got a couple of charts, but like if you look here, this is through mortgage. This is from Mortgage News Daily, and it's from January of 22 to
Are you sharing?
Yeah.
Sorry, I didn't mean to. I thought you
No.
You're sharing.
So you're January of 22 all the way to current, and I mean, so you can see like this was pretty awesome, and it very quickly got.
Would you mind zooming in a little bit? Just do like a control plus or zoom in.
Yeah. Is that better? Hold on. Is it?
There you go.
There we go. Okay.
Perfect. Okay, that looks great.
All right. So yeah, I mean, at the beginning in January of 22, we were still rocking low threes, and then immediately to September of 22, you're over at 7.5. And then, okay, we come back down to 6 in January of 23. Everything's going to be great. No, it's not. We hit 803, which was the high on October 19th. Right. And I mean, you can see this trend. We've steadily gone down, and we've bounced 6% is clearly, when you look at trading and charting, 6% it's a mental thing. I mean, you bounced off of it here, you came in, you bounced off of it here, you came down here in September of 24, you bounced off it again. We got down here again in September of this year and October of this year, and we bounced off it again. But you can at least see there's a downward trend.
Yeah.
Part of that, a big part of that, isn't as much of the 10-year Treasury that we love to talk about. Like I keep that chart up all day, every day, but it's the mortgage spreads. The big thing is not as much of Treasuries as it really is the spreads between the 10-year Treasury and the 30-year mortgage rate. And we've talked about that a lot. This is courtesy of Housing Wire. They put this on their Housing Wire tracker. Anybody can subscribe to it. Obviously, I do for obvious reasons. But I mean, you can see here, I don't have the graphic, but it's 2.09, which when you follow the dance that Logan Motoshami will always talk about the slow dance between a 10-year Treasury and the 30-year fixed mortgage. So in a normal market, it's about 1.75. So if the 10-year Treasury is 4%, then you're looking at about 5.75% in mortgage rates. And it's the spread, it's the difference. As people are buying Treasuries and bonds, mortgage rates improve.
Got it.
Right. So when you look at the 10-year Treasury very specifically, we talk about the yield versus the price. Right. So when investors, government entities are not buying Treasuries, they have to have a higher yield to make them more attractive for these entities that are buying them.
Got it.
The higher the yield goes, the higher rates go. So what we want are lower yields, more demand in Treasuries, right, to bring down interest rates. In general, the spread between the 10-year Treasury and a 30-year fixed rate is generally about 1.
Okay. Got it.
If you look here in 2023, it was awful. I mean, we got well north of 3% at some points, right? And stayed very close there. Last year, the spreads got better and we were closer to about 2.5%.
Sorry to keep asking you the question. So is that because investors consider the Treasury more attractive? Is that the reason why? Like the
investors aren't buying. Yeah, I mean, this is mostly government entities, both ours and foreign nations,
They're buying the mortgage
they're
back.
buying bonds. They're buying U.S. bonds. U.S. bonds are considered the safest haven to invest money. The U.S. dollar currently is the global asset used for trade, right? It's for the most part what they buy oil with. Japan has bought a lot over the years of U.S. Treasuries, as did China. You've seen, and back during COVID, the U.S. government was buying up a lot of our own debt, buying a lot of treasuries. That's why you would see that the 10-year treasury during COVID was 0 to 0.5% to 0.75%, which is how you can see mortgage rates being 2.5% to 2.75% when you've got a 0.5% to 1% yield on a 10-year treasury. What's happened through everything that's gone on in the world over the last 3 or 4 years, a lot of nations have been selling our debt faster than we can buy it up, which has been a problem. So a lack of liquidity, a lack of demand for treasuries, you have to have a higher yield. Mortgage rates very specifically start to follow inflation more than anything, and not just where inflation is, but where they think inflation is going. All of that to say, when you look now at this 10-year treasury, we've gone from spreads being upwards of 3 to now close to 2.09 is what it is today. That's actually where this is.
Got it.
We actually don't have that far to go from where we were to get back to that 1.75 to 2% spread.
Okay.
So if the 10-year treasury now is at 4% and we have a 2% spread, that means mortgage rates, 30-year fixed rates, are going to be about 6%. We've seen it come all the way in January of this year to a high of 4.81. Over here, where are we? April, we hit our low Liberation Day, April 4th, shot all the way back up here to 4.62. Last week, we're down in the 3.95, 3.96 range, and now we're back above 4.07.
Okay.
But the lower spreads is what's keeping mortgage rates from skyrocketing. Because again, if you look at what Mortgage News Daily was at, even right here, as of yesterday, it was 629 on a treasury, on a 10-year treasury, that's 407.
Okay.
You look over here on 1014, it's 631. Back here on 1014, it's about 10 basis points lower. It's about 4.01.
Okay.
So the fact that rates aren't that much higher, even though the 10-year treasury is 10 basis points higher, this is good for all of us. It's going to continue, in my opinion, to be this downward trend. Here's the 10-year treasury yield, and then here's the mortgage rates, the actual rates. That trend follows. So the good news is the worst is behind us. The government has announced that as of December 1, they're going to stop the runoff from their balance sheet, meaning they're
stopping the quantitative tightening, right? Isn't that what it is? Yeah.
Correct. And so what was happening is as debt pays off, refinances, whatever, they're not replacing it on their balance sheet. Now they're going to start replacing it on their balance sheet. So it doesn't necessarily mean they're going to go out and buy a whole bunch, but they're going to maintain their balance sheet. This is going to be good for treasuries. This is going to be good for mortgage-backed securities, and all of that in turn is going to be good for mortgage rates. So where do rates end the year? Somewhere around here. It could be 6%. It could be 6.4, 6.5, but it's going to be somewhere in that range in my opinion. And this is where we are. By the way, when you see average rates being 6.1, 6.2, 6.3, these are average rates that we're talking about. That means a lot of customers are getting rates with a 5 handle on it.
Right.
When the media starts saying rates have a 5 handle on them consistently, I do think that you're going to see some pickup of people saying, okay, now I'm ready.
No, I think
now
so.
I'm ready.
Yeah. I mean, that's another one that doesn't ever, well, usually, right? It did during COVID and it screeched to a halt in 2022, but you don't generally see these like serious swings up or swings down in market demand. You'll see people that have been considering it for a while start jumping off the fence, that pent-up demand. And then you'll see others who are a little more conservative that now think things are good. And then it sort of compounds itself. It kind of snowballs. But as we discussed, and we'll talk a little bit later about this, the missing piece besides mortgage rates, I believe, are jobs. And we have to see the job market come back before we're going to see a real recovery.
Well, so let's talk about that. I agree with that. And there's a couple of other factors as well. One that you and I haven't talked about. I was talking to someone else about this the other day and actually just popped into my little pea brain over here. But uh, that most people are in their home and have their loan for about 7 years. It's about
8 years actually is the average in Austin. Exactly, and nationally, it's like 12, which is crazy.
right.
Way longer
So,
than I thought it would be. Yeah,
but why is that, right? Life happens, right? People get married, they have kids move out, they downsize, they die. This is what happens. Okay, so if it's 7 or 8 years, right, and we're talking about people that started, we always talk about these low rates. Everyone's got 2.5%. Not everybody does, and they're in a, you go back to 2020. Win 7 years from 2020. Next 2 years from now,
well,
right?
yeah,
27, 2028, 2029. People are outgrowing their houses. People are outgrowing those mortgages, and less of the overall mortgages that are out right now have one of those low rates. You're seeing more and more mortgages kind of in that average 5 to 6 rate overall. I mean, you've got people that are now refinancing. We talk about sales, and sales have been down. Yes, refinances have been up. So I talk about the mortgage company being okay. It's because what we're not getting in sales, we are making up for to a certain extent in refis.
right. Well, I think, yeah, I mean, I think this is the pent-up demand that we always talk about, and the pent-up demand is there. And if you want to put a number on it, nationally, you generally see 6 million sides a year, 6 million sales, right? For the past, I think, 2 years now, nationally, it's been 4 million is the number of sales, right? Now, the city of Austin tracks, or sorry, Austin Metro tracks with that. I don't have the numbers right in front of me in terms of our unit count now versus our unit count 3 years ago, but it's not great. It's not great here. But as you said, life marches on, and these external factors that cause people to, to want to buy or sell continue to happen. An interesting one, and this is positive. You've heard of the phrase the silver tsunami. Have you heard of that?
No,
Yeah. So the silver tsunami, it's the baby boomers.
I was going to say I could figure what it
Of course,
is.
yeah, and it's the fact that these folks, by and large, are staying in their houses. They're not downsizing, right? I mean, they're well past knee replacements, and a lot of these guys are in 2-story homes, right? So you will see that continue to put pressure on them to move out, and whenever they move out, a lot of them are going to buy elsewhere. We don't necessarily need the inventory in Austin, but you'll start seeing people become more motivated. That could actually that could push downward on pricing, but at the end of the day, like, we need more motivated sellers, and we're not going to talk about it on this episode. We'll probably talk about it next month, but the success rate versus failure rate right now is just hideous in
Oh
Austin.
yeah.
We need to see people more motivated to actually get the deal done.
Well, and along those lines, I think you just have a lot of sellers that don't have to sell, so they're not. What I'm really curious about, and what I think is going to happen as rates start to get into the fives, and I'm only talking about Austin. I'm not talking about nationally. But as rates start to get in the fives, I think we will see buyers start to come out and fill the demand. I don't know that it's necessarily going to bring more inventory, but I do think it will bring in more buyers to start soaking up that inventory. I don't think that you're going to see appreciation skyrocket because of this. And I think that we probably, if we're not at the bottom, we're knocking on its door right now. So I very firmly, with all my core, believe that the worst is absolutely behind us.
I agree. I agree with you. Now that said, this year was a little bit worse than last year in terms of overall volume, but it doesn't feel bad. And I think that even with a 4% decline in overall sold volume in the resale market, there are other forces that cause those who are working agents and working LOs to actually have a better year. Not everyone, but by and large, a lot of people you're talking to are doing okay. I had lunch with an agent I've known for a long time today, and obviously, first question is like, "How are things, man? How are things going?" And he said, "You know what? They're fine." They said they're fine because it's all relative. And in 2023, whenever you were comparing it to 2022, or 2022 and you're comparing it to 2021, things seemed really awful. Now, whenever we're comparing 2025 to a pretty crappy last 2 years, it really just seems fine. And we've settled into, these are the actions we take in order to make money. And long-winded Eric again of like, yes, I absolutely agree with you that the worst is behind us, but when's it going to get better? That's really
Yeah.
the question.
So I think next year is going to be marginally better. It's not going to be a great year. I think it will be better. We will have lower rates. There will be more buyers. If you're a loan officer or you own a mortgage company, you're going to have more opportunity for refinancing, which is going to help from that perspective as well. But what is it going to take to bring more jobs and to bring hiring back very specifically? I'm really looking at the Fed, and I'm looking at what's going on from that perspective.
So if I can take this for a second and we can bounce around for just a minute, I'd like to just move on to the national leading indicators because that's where this conversation is on. So I'll share screen, and I'd like to just share a few things, and this is really topical. So let me see. All right. So when we talk about jobs, here's a visualization of what has happened to City of Austin or Austin Metro and jobs. And this is January 2022 to September of 2025 is actually it's October of 2025. It's just not on there right there. And you can see that, for about, looks like a year, it was just a sharp drop. And then we've been skipping across the bottom now since looks like January of 2024. So whenever you look at the rate of change, we actually now are at 5 months of positive year-over-year change. Doesn't mean that things are improving dramatically. I really think this is really more indicative that things are just not getting any worse.
What's funny about this chart, we were talking yesterday, when you talk about like new mortgage applications and mortgage applications are up. Well, if you had 4 mortgage applications last year and now you have 6, that's a 50% increase. And so like the percentage increase is almost irrelevant coming from such low bars. And it's just funny seeing that same chart because it makes me think the same thing.
I agree. And what I'm looking for really, whenever I look at like a positive rate of change versus a negative, we had negative rate of change for 2 years, 2.5 years. No, I'm sorry, 3 years. And then to see it finally turn a little bit positive, it says, okay, great. It looks like the worst is over whenever it comes to jobs. But I want to get to the Fed because that's what you mentioned. We have unfortunately in Austin been ahead of the curve whenever it comes to the recession. I think in the past, in 2008, we were very lucky. We were last in, first out of that recession. Here, it's not the case. We were first in. I don't know if we'll be last out, but there's no reason to believe we'll be first out. No question, right? The tech industry was incredibly bloated, and they started just cutting jobs in 2022. So I don't think that our experience has been across the United States. Your folks in Florida, for example. Whenever you talk about, does the recession feel new to them, or have they been in a bad market for a few years now?
Well, it's interesting because the group that I have out there is run by a gentleman who was a producing manager, and so he was kind of splitting duties between managing a group of loan officers and kind of running his own production a little bit. And he decided to get away from that and really just focus and double down on production. So for him, he's crushing it this year. He'll do 100 million plus this year with him and his team. So his experience is a little bit different.
Got it.
But when you talk about in general feeling the recession, it certainly is not like in Austin. And you can see that. If you look at the news, every chart that comes out, every poll that comes out, Austin is seeing the biggest decline percentage wise in pricing and the biggest decline of people moving out of Austin. And, a lot of that. So, I think that other areas are not.
Narrative plays really well in the news, right? Because we've been the belle of the ball for such a long time that, it's something that will cause clicks to say like, look, Austin flew too close to the sun, wings melted, now they're cooked, as our kids would say, right? I disagree with that wholeheartedly. I think that's a topic for another day, but I think that Austin will come back. I think we have all the ingredients to be really good. But to share with what I think is a relatively recent change, the rest of the United States is now joining us for better or worse.
Misery loves company, pal.
There it is. And so whenever I look at this is consumer sentiment, similar to consumer confidence. You talked about Liberation Day. Well, that was the low point up to this point, right? Tariffs hit. Consumer confidence dips to an absolute low, and then it slowly starts creeping back up. Well, then there's more uncertainty. Now it's the government shutdown that's probably caused it to dip as low as it is. But yeah, we're at a new low, and this is national, right? This is and when consumer confidence is low, people don't buy expensive things. You don't go on the expensive vacation. You drive somewhere. You don't buy the new
Right.
car. You say, hey, my car is going to be fine. It still runs. And you don't go buy a new house. You say, look, I'm fine where I am right now. I'm going to wait. Wait and see makes a lot of sense whenever you're not confident, in the economy. So with this, and going back to, the Fed, this is where the CME FedWatch tool puts us right now. We have it's split. Market expectations are split that we'll see another rate drop this year. And
You
they're
know what's
actually
interesting is before at the last Fed meeting when they cut, at that point it was about an 85% chance of another rate cut in December.
I haven't watched the blow by blow. Do you know what happened to cause the market expectations to drop down this low in terms of another rate
Well,
cut?
so it started with what Powell said when he cut rates at the October meeting, and that uh, he said that a December cut is not a foregone conclusion. We're going to remain data dependent. We think that the job market is not, what basically what we're seeing is a lack of companies needing to hire people because of all the tech layoffs due to AI. You hear Amazon's laying off this, Apple's laying off that, Meta's laying off this, and just more of the same thing. So he says this, then we have a government shutdown, so now data's not coming out, and if we're supposed to be data dependent and rate cuts, but we're not getting the data, then what do you do? So all of that kind of played into it. I'll be curious to see how it really plays out. I certainly would not be surprised to see a cut. We're not going to get October numbers. The White House came out and said they don't exist. We're not getting them.
It's unknowable.
We will get September numbers, but because of the shutdown, the October data was just not it wasn't received, mostly because their data is calling households and asking questions.
Right.
But we
Well, I
will have
agree,
November
I agree
information.
with you that I wouldn't be surprised if there's another cut in December either. I mean, it's coin toss here. I mean, according to the market. But then if you look at how bearish the market has become on the rate cuts in general, now we extrapolate to March, and there's only a 1 in 3 chance that we're going to see going to see 2 cuts by March. And I think previous to this, it was considered a foregone conclusion that we would have 2 rate cuts. That would have 2 rate cuts by March. But okay, so let's pause on rate cuts for a second, because I know that you have some theories that I agree with regard to what will happen in May. And let's find. Okay, so here is fear and greed, and I actually had to. Well, I didn't have to. I did take a new screenshot today. I had a different screenshot yesterday where it was in fear. It was like 28 or something like that, and it's the stock market has dropped into extreme fear today. It's at 24 out of 100 in terms of
But look where it was a week ago. Look, a week ago,
is
it was
18.
also at extreme fear, right?
And this is a major change, right? And recent major change, because 2 months ago it wasn't the case. And the stock
So
market has remained stubbornly bullish and greedy for a long time, but it is certainly stopped now. The stock market looks like it is going in a bad direction, which is good for us. Bad news is good news, right? In terms of
bad news is good news. And also I look at that and what I see, not necessarily just in housing, but what I see when we talk about the stock market, it's opportunity. It's opportunity, right? It is extreme fear. You should be buying. Tesla was 475 a week ago. It got under 400 today, right? Like it's time. Start buying. We were at extreme fear in April, Liberation Day, and we thought the S&P might drop down to 4,500, 4,600. I was getting calls from agents who I won't name that we know very well. We're not going to be able to retire now. My portfolio is down 30%, 20%. Don't sell, just wait. Sure enough, it comes right back. That fear and greed index, man, I love it.
No. It is a daily temperature check. I do not make decisions based on it. I think that fear and greed is a leading indicator of where we're going to see consumer confidence. And yeah, trying to time the market based on fear and greed, no, it's an interesting data point. Yeah.
I think when it's extreme fears when you buy, and when it's greed you sell.
Well, you've listened to Warren Buffett. That's the reason why. I mean, that's the famous quote: "Is you want to be fearful when others are greedy, and greedy when others are fearful." It's hard to time it
Exactly.
correctly, but yeah,
Yeah, but so
But going back to it, so it's another, in my opinion, another indicator of a market that's catching up to where we are in Austin, right? Like we needed, we either needed to bounce back without a national recession, or we needed to see, numbers get bad nationally so that the Fed would start easing. And you and I focus so much on mortgage, but the Fed monetary policy dictates a lot more than that. It dictates liquidity. And so when things are liquid, people are going to hire, they're going to invest in their businesses, which they're not doing right now.
That's
So
right.
the Fed monetary policy is a fantastic leading indicator of the overall economy and when employers will start will start hiring again, which is my big question.
Well, and so here's what I think to that, right? Like, we may or may not have any more rate cuts. Maybe we get one, maybe we get two, maybe we get none. Powell is out in May. His term is up. Trump is going to appoint someone else. Whether you like Trump or not doesn't matter. What I think everybody can agree on is whoever he puts in there is going to be on his agenda. And they're going to do what he wants to be done. They're probably going to cut rates very quickly. On one hand, we think, okay, that's great. On the other hand, it does make me very nervous. If you cut too fast, what happens? Is that inflationary? What does that look like? Are we creating a bigger problem for 2 or 3 years, 4 years down the road? Nevertheless, there's probably going to be substantial rate cuts starting May or June of next year, right?
If you want to go to one of the predictive markets and put money on it, I think that's the smart bet. It's a pattern that matches 100%.
Well, rate cuts take about a year, 6 months to a year, to really work their way into the system. So if we really start having aggressive rate cuts in May or June of 26, then you probably see that come through sometime beginning to middle of 27. Employers are now, in theory, hiring again, back in a shrinking unemployment, growing job market, which for us is good. Now, what does that look like 4 or 5 years from now? I don't know.
Well, we're not
But
here to predict that. I mean, that's don't get over your skis and save your money whenever times get good again. That's just the rule of thumb you have to live by.
100%. But in the meantime, I think we go back to, I think next year will be marginally better. I think 27 and 28 can be really, really good. And then, who knows? We'll go from there. And then you get into an election year anyway, and that always has some ramification. But
agreed.
I think
the only curveball to it is, and I am not a believer that AI is replacing these jobs. Our mutual friend Emerson, who's replaced a ton of people, he's uniquely positioned to do so because it's an ad tech company. I think companies like that can bring AI in to do graphic design, copywriting, things like that. Yeah, sure. Did AI replace copywriters? 100%. Companies went out of business for it. Is AI replacing a large percentage of graphic designers? Yes. It's not replacing coders, no matter what they say. It's just simply not. It hasn't started replacing customer support yet, and that's actually probably a ways away. But what has happened, and I think it started with the Twitter buy, whenever the other tech companies saw, Musk come in and buy Twitter and then cut the staff in half and aggressively find inefficiencies, and then revenue didn't go down. I'm not even talking about profitability. It wasn't like they found profitability and their revenue went down, but they're making more money. No, revenue didn't go down. And so the other companies have followed suit, and you have companies like Google, Meta, Apple cutting staff, and revenue is staying the same. So I think that in terms of when does hiring begin again, that is really the only outside chance, is that these companies hold on to this additional profitability for a bit longer than they would have in the past. My fear is that they were so bloated for decade before and didn't know it, that maybe some of the jobs are gone forever, not because of AI, but just because they were so inefficient.
Maybe, but just like with any new industry, everybody gets worried about losing jobs, but really what it's doing is creating new jobs. And now you're going to have this new era of AI operators, right? Like that's going to be a job, an AI operator. You need to have that. We talked yesterday, the iPhone came out. Everybody's worried about all the things that are going to happen because of it. But then what happened? It created a whole new world of, now you have Twitter and you have Uber and you have DoorDash and this whole gig economy and all of those things.
I listened to a podcast the other day, and I love the comparison because everybody's been comparing this to the .com boom and then bust, obviously. But I don't remember the internet taking away that many jobs. It took away a few. A few categories, right? They compared it to the computing revolution in the 80s, and they said, you didn't have file clerks anymore, and you didn't have traditional bookkeepers anymore, but it birthed the IT department. So you did need these people to run these new systems, and I completely agree with you. Now there's a whole hour-long podcast we could probably do, and you and I aren't qualified to do it, but to talk about what does it look like 20 years from now, 30 years from now, like a big futurism sort of discussion. And those are really interesting, but I don't think that they're worth discussing for any realistic business planning or any strategy discussion.
100%. I think that all you can do is continue to plan for what you know and prepare for what you think.
Yeah.
What is your, I mean, you say it all the time. What's your baseline? What's the most likely thing that can happen? And what's the least likely thing that can happen? And how do you plan for that in the middle? I mean, that's where it all is.
So I'm not surprised that we landed here on strategy, because that's what you and I love to talk
Yep.
about. I'd like to go over the stats, real
Yeah.
briefly. We can have a
Knock it out.
baseline, and then I want to jump right back into strategy, because that's what's most interesting to me, and that's what I think is most interesting to everybody here, yourself included. So I'm going to run through the stats, and these are the same stats that we share in our newsletter and that I do a quick video over. So if it's repeat information for some of the folks out there, I apologize. But when we're looking at October, the numbers look very similar to the way that they've looked for the past 2 years. And that is that, okay, we saw sales come down a little bit, 5%, but last month they were up. Under contract pending, relatively flat. New listings up, active listings up. Nothing super, super actionable or meaningful. This month was a surprise in that we saw more positive movement on price, but I wouldn't really, go to the bank with that. I certainly wouldn't take away like, oh, pricing is coming back. 1 month doesn't make a trend, and that's what I believe here. And also the movement, with the exception of average sold price at 6.1% increase, it's very, very marginal. So what it looks like to me is that the market is continuing to plod along and not really go up and not really go down and just be really, really sluggish. This is the overall volume sold. And even with total sales dropping by 5% with the increase in price, we saw it almost entirely flat in volume for the month of October. And then year to date, almost flat with last year at, just a minus 2% change in total volume sold. That's about the strongest indication of demand that you can get, is how many dollars are trading in the market. And then every buyer and seller asks, is it a good time to buy? Is it a bad time to buy? What they really mean is it a safe time to buy? Is it a safe time to sell? And when you look here on a 13-month trend, yeah, it's about as flat as it goes. Backing it out to 24 months, still incredibly flat. Average is up just a little bit. Median is down just a little bit. So yeah, if you want to wade into the market right now, you're not catching, a falling star if you're a buyer, and you're not going to have to, if you price it correctly from the get-go, you're not going to see your price drop dramatically if you're a seller. So there's the world's fastest. How does the market look? Max, you and I talk about this a lot. Do you have any takeaways here that I've missed? I'd love to open it up for
No,
you.
I mean, I feel like you hit. I mean, it's the same stuff that we always talk about. I mean, that's it. I mean, like I said, sales were down in October, refis were up. So what we lost in sales, we kind of made up for in refis from the mortgage perspective. But I mean, it's not really getting worse.
Yeah. And I want to go one step further and look at resale only. It's something that we sliced up.
That's my favorite thing to look
It
at.
is, yeah. And so if we pull it out and we only look at resale, you're going to see the numbers look a little bit different. And it's a deeper decline in total sales, minus 8%. Under contract pending dropped by 5%. And then here's what's interesting is that all of the pricing numbers actually went up. Fewer homes selling, but stickier on price. And I think that makes a lot of sense. Oh, look at this. So average days on market from 73 to 86. And so what I did this year that I've never done before was look at only new construction. I wanted to see how it behaves. Total sales on new builds up 13%. Total under contract pending up 22%. And then here's what's interesting. You look at pricing, average sold price down 2.5%, median sold price down 4.5%, sold price per square foot down minus 6%, and median down 8.5%. When you look at them side by side, you can see the stark difference. So new builds, total sales up, I could almost say way up, under contract pending way up versus down 5%. And then the pricing. And so when you look at this, as somebody who is here to help folks sell their homes, if you're competing with a builder, man, you've got some stiff competition, right? These guys are cutting prices in order to sell a lot more units. Yeah. And then you look at it from a real estate professional viewpoint, and by definition on our side, like we can only participate in 50% of the sides because we're not listing these houses. They don't list, right? I mean, they list with like flat listing brokers or whatever, but there's no money really changing hands. And then for you guys as well, I mean, how many, I know you guys do a lot of condos, which is awesome, but when you shake everything out, like what percentage do you think you guys participate in on new build side?
Not much at all. I mean, I got an email from one of your agents this afternoon. We were checking on a deal, and they went under on Lennar on Sunday, but got massive closing costs to go. So they had to go with Lennar. Otherwise, they lost that. So like, there's a lot of that. And these builders, they're not making money. They're pushing units. They're getting stuff off their books because they have to, but they're not making money. So our percentage of new construction, new builder business is really very, very small. And I don't really put I don't put condos in that same category. A DHI, NAR, a Taylor Morrison, it's going to be a lot different, in my opinion, than a One Oak or a Modern, and one of those things.
Yeah, no, absolutely. Okay, so this is a chart that shows Lennar's numbers. They shared this I think on X the other day. And this is the percentage of sales incentives as a percentage of revenue, right? So you can see that back in 2009, way back in the good old days, when they had a ton of inventory and the sky was absolutely falling, that's the only time that they've offered more incentives. And then they continued doing it up, through 2012 to keep building, but not as money as they're offering now. So, look at this, like the valley of this was, they were only giving 1.5% as a percentage. Our sellers are generally offering around 7.5%, right? So you got 6% in commission and then another 1.5% in closing costs. They're giving almost double that. And we see that manifest in the way of rate buydowns. So whenever you see these guys offering 4% interest rate, what that means is that they're paying out, what number would that be? 6-7% in buy down in order to get to that, something like that.
Yeah, at least.
Yeah. So what does all mean, right? I mean, at the end of the day, the numbers that we have at the metro level don't look awesome. But then when you drill down to resale, well, for our clients, the pricing looks a little bit better, except the liquidity of the homes looks a little bit worse, like than the overall market. What I don't have here, and there's no reason to share the screen, but the total volume is down by 4.2%, I believe, on resale. So it's a bit tougher. The market out there is a bit tougher for real estate professionals than the overall numbers show. And then going back to what you were talking about with some conservative assumptions we can make that next year is probably going to be maybe a little bit better than this year. And we probably won't see a real path to recovery until the following year. What do you do? I mean, what are you strategizing? How are you coaching your LOs? What are you doing as a business owner? What does it mean?
It's funny. You talk a lot about do what works, right? And while I don't really say that verbatim to my team on our weekly calls, it's just continuing to hammer. Make your phone calls, check in. You've got to check in with your clients. You've got to check in with your real estate agents. You need to check in with people that you closed a year ago or a year and a half ago. Do they have a 7 on their rate? Call them. Do they have an 8 on their rate? They should be refinancing right now. Agents, and I feel bad for agents because, everybody that's a loan officer or owns a mortgage company or coaches loan officers or whatever is saying, call your agents. So the agents are all, let's go to coffee. Let's go to dinner. Let's go to lunch. Let's go to happy hour. And I feel bad because they're like, just leave me alone. At least once or twice a week, I get BCC'd on an email from an agent emailing back another loan officer very politely saying, thank you, but I've already got my team. Wish you all the best.
That's fine. Like I respect the hustle. And I look at that as your folks are prospecting. They're trying to find new business. Great. That's the same thing that we coach agents to do. And that is go host open houses, work internet leads, make outbound calls, meet people. As we've always talked about, you've said, what is it? Action creates, or
positive attitude, positive actions creates transactions.
There we go. That's
it. So that's what you do, right? You do what works. It is a numbers game. But loan officers and real estate agents have a massive database of people, especially if you've been doing this 5 or 10 years, if not 25 years. You have a massive amount of people that know you, that like you, that you've done business with. And
get uncomfortable. Give them a call. That's really it.
Be comfortable being uncomfortable.
So we interview a lot of agents, and we have green flags, orange flags, red flags, whatever. And one of the biggest green flags, we're talking to an agent who has said, I want to get my production up for whatever reason. They had a down year or whatever it was. I'll ask him. I'll say, well, cool. Like, what do you plan on doing? And it's a major green flag where they go, oh, I'm just going to do open houses. Really? Tell me about that. Yeah. Every time I do open houses, I always pick up clients. Well, not on every time, but I do enough of them. I pick up clients. So I'm just going to do that. I go, that is phenomenal, right? Like, you're not asking me, like, do you have magic leads? Which we have leads, but that's the wrong answer. Or, you're not saying, like, what's the trick? Well, sorry, man. Like, the trick is hard work. The trick is like going out and pressing the flesh and meeting people. So,
Well, and that's what I said earlier. For 20 years, a lot of us thought we were really, really great at what we were doing, and really we were just pedaling downhill. And so, like, now, are you pedaling uphill, and are you getting there, or are you so out of shape you got to get off and walk?
okay. So you and I've preached this. I remember we started talking about this in 2022. We were telling folks, like, you gotta keep your chin up. You need to make sure that your attitude is strong, good attitude, and keep working. What else? In the nuts and bolts of business planning for next year, business planning for the following year, investing in marketing, like investing in expenses in general. What are you doing right now?
Well, we're from a company perspective, from a Lehman Team perspective, we're at least making money that we can invest that money. So what does that mean? Well, we're trying to build new tech to do different things to make everything easier on the loan officers, more one-click buttons to be able to get messaging out, whether it be a social media graphic or an email or a closing gift, or whatever it is. Like, what other things can we do to bring value? We do a lot of one click button co-branded flyers with agents. We'll create a new flyer, and we mass email the entire agent database and say, here's this new flyer we created. If you want it, click here, and it's going to be co-branded with your stuff on it. So, like, there's a lot of it's stuff like that, but it's also getting out there. It's not just sitting behind your desk. It's calling agents, it's checking on deals, it's following up on past deals, it's letting agents know what is going on with the deals that they sent you 6 months ago that people are still waiting, or when they get resurrected, or even making those tough phone calls. Agent referred you a deal, that person's going to work with you, but they decided they want to work with another agent.
Can I ask you a real pointed question? What percentage of your deals are sourced from an agent referral versus like everything else?
Lehman Team is now, I should know this off the top of my head,
Just
it's
yes, close.
roughly about 40%, 50%.
Oh, really? You're 50. I figured you'd be higher than that. Yeah. So the national numbers are 60% of all real estate transactions that are brokered, right? This is for real estate professionals, are sourced from a past client or referral, which I think is low, because I think that most agents don't have their databases very, very dialed. The point of this is that that's 40 to 50%. That's probably the largest category you guys have. You probably don't have another lead source that outperforms agent referrals. Is that?
That's correct. It's always like agent referrals is the biggest, like, that's the biggest. And the only reason I would say that it's 50%, especially this year, is because we've had so many condo projects closed. So, we've had, like, and that's another, like, those aren't agent referrals, but those are, an agent might have got us on the project, but we're looking at that as either the developer or the project itself. So whether it's Modern or George or Congress Lofts or One Oaks, even Vesper, there's some projects in San Antonio. There's a lot of different condos that are in there, which is really the only difference.
Yeah.
This year.
Well, my insight is this, is that you're like, you guys investing in tech strategies, you just putting money into helping your LOs get more agent referrals. We are actually taking the exact same strategy, where we're investing the most heavily into agent SOI, right? Helping the agents organize their databases, helping them send out gifts, reminding them to call people on their birthdays, things like that. So the strategy is the same. And if I want to, like, distill it even further, it's that we are both investing money into what we know for certain works. We know that this is the most effective thing. It's not time to go out and perform grand, expensive experiments and hope that you strike gold. It is the time to say, we know that this works. Let's put our time into it. Let's put our money into it, and let's try to squeeze out some more. Let's not try to do anything fancy.
That's right. And then from a company perspective, we're recruiting. We are about to kick up the recruiting efforts very, very significantly.
Yeah, well,
to diversify outside of Texas, outside of Austin, and get into, some of these other states where we can bring a lot of value.
Well, you guys, I mean, after muscling through a tough time, cutting some expenses, you guys are in a place of stability now. Now it's time to start being, more aggressive. You guys have a great thing. So, go sell it in a crap market, and you'll be able to outwork the competitors that are just worn out.
That's right. Yeah.
Yeah. So this has been awesome. Thank you very much. Any final thoughts, any kind of takeaways that you want to express to anybody out there at all?
I think really, man, like we should all just be grateful. It's easy to be like, it's not great. And I wish it was better, but it's been considerably worse. How many agents do you know that lost money in 23 or didn't make any money? Because even as an agent closing deals, you still have expenses, you have your staff, you have your technology, you have whatever it is under your little business, your corporation, whatever it is. So I know a lot of agents that have teams that their teammates, their employees got paid and there was no money left over, right? So now you've gone from we're losing money or we're not making any money to we can pay the bills and maybe we can take a vacation or maybe we have a little bit of money in savings. And it's so easy to dwell on the bad. We think about, at least most of the loan officers I know, and I imagine agents do it too, remember the deals that are lost more so than the deals that you won.
Right.
Right. And maybe because you lose more deals than you win if you talk about from lead to closing, yeah, nobody has a plus 50% conversion rate from lead to close. I mean, maybe some do, and that would be amazing. But like inherently, you're going to lose more than you win. But if you've only focused on the losses, you get into a negative headspace. And like we've talked about, positive attitude is so much of all of it, right?
Well,
Positive attitude, positive action equals transaction.
even if you are the most cynical person in the world, if you keep a positive, you have to acknowledge that if you keep a positive attitude, you can work longer, right? So even if you are a person that thinks like, oh, this whole, mindset thing is just BS, which I don't believe that at all. You can see it that when people do maintain a positive attitude, they work better, they work longer. So if your attitude's not right, like get it right, fix that first, and then start working. You don't go to the gym when you're sick, right? Or I don't know, maybe you do. You're pretty jacked.
I do, but
I don't go to the gym when I'm not sick. So
there's that. I go to the gym when I'm sick because it
I
definitely
told
makes
you
me.
yesterday I went to the gym for the first time in a decade on Monday, and my triceps still hurt, man. Like it's the worst. No, I couldn't
Well,
agree. I couldn't agree with you more. Like
yeah,
gratitude is incredibly important.
and I think if like as we're talking about that, I think as we're going into the new year, like that's going to be my mantra for 26 is just gratitude. Like glad that it's here, glad that we've dug ourselves out of the dirt, glad that there's less loan officers in the industry now on my side, and just like do what works and be happy.
Right. Yeah. Yeah. I got nothing. You nailed it, man. Thank you very
There you
much.
go. There you go.
Awesome. Well, thank you everybody for sticking with us this long. If anybody has any questions, you know how to find Max, you know how to find me. We both genuinely love problem solving. So if you're a buyer or seller, if you are a real estate professional, hello, real estate agent, anything else, like reach out to us and we'd love to chat with you. And thanks again.
Absolutely.
Hey, gratitude. Thank you for watching the show.
Thank you.